Welcome to the World According to Boyer, where we bring top investors, best-selling authors, and business leaders to show you the smartest ways to uncover value in the stock market. I'm your host, Jonathan Boyer. Today's very special guest, Michael Santoli, is well known to regular watchers of CNBC. Michael serves as a senior markets commentator for the network. Prior to that, he was a senior columnist at Yahoo Finance, and before joining Yahoo, he spent 15 years as a columnist and feature writer for Barron's, where I was a regular reader of his column Streetwise. Michael, welcome to the show.
Oh, great to be with you, John. Appreciate it.
Thanks for coming on. And yeah, I'd love to hear a little bit about your career. I mean, you graduated from Wesleyan with a degree in history. And how did you end up in a career in journalism?
Well, the journalism part was, to the extent that I had a plan in school, it probably involved journalism, even though I didn't study it. But the financial journalism piece of it was somewhat more accidental. Wesleyan, of course, just kind of a pure liberal arts school. So it was not really going to have something like a journalism degree, which was fine with me. I felt like majoring in history was sort of choosing a major without having to choose, because everything is included in history. And I was writing a lot and all that. But I did work on the college paper pretty extensively. In fact, for a couple of years there, it was pretty much what I did at school. I edited the paper at some point. So I did think that it would be maybe my first choice of something to do afterward. I didn't do the greatest job in laying the groundwork for a career search necessarily before I got out of school. And so I had a few leads, but where I ended up hooking on was at a financial trade publisher. And I actually got the job through a New York Times Help Wanted ad. There's not many people who can say that, who are a lot younger than me at this point. But this is IDD, it was called Investment Dealer's Digest, still exists in some form. The business model was very high-priced weekly newsletters for very narrow financial subjects, only for professionals, and they would hire young people, just teach them in a hurry the language and the ropes and the content to some degree, and work them as hard as they could. And then they inevitably went off somewhere else within a couple of years, and then they hired a new crop. So I was one of those, and I was covering the syndicated loan market, and I was covering IPOs, and really had no firm background in this stuff. It was really just learn the beat, learn the language, try to work the phones. It was a great experience in the sense of being on a steep learning curve. From there, though, I went to Dow Jones Newswires, where I covered the securities industry, and that was a great training ground just to be able to write quickly and clearly, figuring out what the story is, learning a wide range of financial topics. And all this time, one of the reasons that financial journalism ended up being a place I stayed was because it was expanding and it was becoming more mainstream throughout the 90s. And it seemed like it was interesting, and the markets were getting interesting. And as you said, I went to Barron's from there. Pretty common route to go from Dow Jones Newswires to Barron's, owned by the same company. Barron's very market-oriented, but a lot more column-centric and a little more deliberative in terms of what you want to cover and where you feel like you have an edge, and trying to be a little bit contrarian and trying to bring fresh info. And that was the bulk of my career, I guess. And all along the way, just to knit it up, I had done some video and TV. So Dow Jones had a deal with CNBC in the 90s, and I was a contributor, and I was kind of a point person to do television. And so that grew to be a bigger part of what I did through Yahoo. And of course, now at CNBC, where it's pretty much the main gig.
Barron's has a great history of kind of weeding out frauds. I mean, they were the first ones, or one of the first people, at least publicly, to question kind of Madoff's returns. I don't know if you were working or around that story, but it's amazing that the regulators didn't run with it then. It would have saved people tons of money.
Well, it's funny you say that, because I thought you were going to say Charles Ponzi, because Clarence Barron, one of his claims to fame was having partially exposed Charles Ponzi as well. But no, I was not directly a participant in that Madoff story. A colleague of mine at the time, Aaron Arvidland, was writing about it, and interestingly had coming at it from the options trading side of things, where it was just like this suspiciously regular returns, as you know. And it's tough to put a real fine point on those stories, because you don't really have subpoena power. You don't really know everything necessarily, but you can raise the question. So no, I really love that about Barron's, and still certainly respect it. And it was great. For me, leaving there was much more about exploring different parts of media and how media was developing from there, in terms of Yahoo, kind of like the the opportunity to be the sort of over-the-top free Bloomberg with video and just to get an idea of how things were flowing in free internet, so to speak. And then, of course, CNBC, I've been kind of in the orbit of CNBC for like over 20 years, and it just made sense to settle in here at some point.
And you're basically on CNBC throughout the day. And like, how do you prepare for the show? When does your day start? And like, kind of, what are you reading? I mean, it's really, I mean, you have to be able to react to almost anything.
It's sort of a constant process. It isn't so much a defined menu of stuff that I consume, but I start on the early side. Even if I don't have an on-air booking in the morning, I'm usually kind of up and moving and looking at the news. And, I'm a lifelong kind of newswire headline watcher in real time. And Twitter has absolutely replaced that at this point for the most part. And if you curate it well enough, you pretty much get a sense of the stories of the day and what seems to be relevant for markets. So I will do that scan. I definitely have access to a lot of sell-side research and these sort of research boutiques and all that stuff, as you can imagine. And I've had to kind of chop it down into stuff I find very relevant in real time and try to figure out my touch points. So I start scanning all that stuff on the early side. I'm usually preparing for an 8:15 editorial meeting we have here with at least some take on the markets in terms of what's going to matter, what's not going to matter, where we are in terms of like field position in the markets, what some of the main bullet points that I think, are relevant. And from there, I could have, a lot going on in the morning. I could have nothing. I'll review to a degree what guests we're going to have. But mostly I'm watching the tape. And I watch the tape in conjunction with a lot of kind of color commentary that I'm reading about it, whether it's on Twitter or just kind of back and forth messaging with people. And I always do write a midday kind of memo, this like just series of notes on the markets, and I've done it internally here for a while, mostly just to prep people for the show and prep the anchors. And now we run that out on CNBC Pro, a subscription service in the afternoon. To me, it's just kind of like my desk notes, but I just think as a snapshot of what's happening in the market, I like to have that. Again, it's like you write to figure out what's important. And then I could just be called on to comment on almost anything. So the thing about TV is I've a little bit of an adjustment is that the main story is usually the story. What I mean by that is it's not like when I was at Barron's where it was, oh, well, let the news kind of get out there and people can talk about it. And we're going to find out the unexplored angle. And we're going to find out what it kind of means. I have to sort of fixate on the main event of what's happening. My ultimate goal is to place it in context, whether it's historical context, whether it's in context of what a particular company's done before, or whether it's a response to competition, or whether this particular type of market move is strictly technical, or whether it's some major style shift or theme that's washing through the markets. So all that stuff gets thrown into the mix. And I have to say, I wish I could feel as if it were more orderly than it is as a process. It's much more just consume as much as possible and try to eliminate what's not relevant.
So it's interesting. You mentioned Twitter 2 or 3 times so far in the interview. It's full disclosure, Boyer Asset Management owns shares of Twitter, and we wrote about it. And when it was about $29 a share earlier this year, the company has a market cap of $34 billion, which when you compare it to like a Facebook or some of these others is really quite small. Yeah, are you surprised based on the utility of the service that they're not much bigger than they are?
Yeah, I think on a top-down basis, I'm surprised given its importance in the kind of information ecosystem, the engagement of the people who actually are on there. I guess I'm just less surprised given the fact that it sort of suffers, I think, a little bit from the comparison to Facebook, where the monetization on Facebook seems just automatic. There are quarters where Facebook, it seems like they're trying to hold it back and try not to seem like that they're this magical growth machine. So 34 billion, though, to your point, is in today's market is not a big number for a company that has carved out that kind of a place. So I don't know exactly what to do with that in terms of like, I wouldn't have a prescription for how Twitter should operate differently to try to change that. But there's no doubt in terms of how crucial it is to people who do what I mean, I think the knock on it to some degree is people in the news business and people obsessed with things like politics and sports are completely saturated in Twitter. And for other people, it's easy enough to ignore. But that might be changing as well. It seems like it's becoming much more central.
Yeah, no, to me, when we were doing our initial work, it just amazes me. I mean, at that time, it was in the 20 billions, and it was roughly where it was in their 2012 IPO. So it seemed somewhat of a no-brainer. I mean, but you have Jack Dorsey who runs it, who's a brilliant guy, but he's also running Square, and he has other outside interests. So I wasn't doing it in terms of how to jack up the stock price, but to me it was just amazing that a professional like you, and I'm sure you're not the only one who relies on it for news, it's just so comparatively small. It's always kind of amazed me of that. I follow you, or my firm at Boyer Value, follows you on Twitter. You talk about, and you did it at Barron, it's about this mystery broker, and it's a really interesting story. And I'm certainly not asking you, and nor would you reveal your source, but do you mind just telling everyone how that came to be?
Oh, sure. It's fascinating to me that it became the phenomenon to the degree that it has. And it's a weird lesson too, I think there's a behavioral aspect to it, which I'll get to after, as to why people so flock to it. It's just this mystique of secrecy that I think amplifies people's sense of somebody's importance, perhaps. But the way it all started was, it was really during the global financial crisis. I was writing my column at Barron's, and this guy, and what I've said about him is just that he's a guy, he is a broker, he's a financial advisor, but of kind of the old school, got into the business in the 80s, and seems to have like discretionary accounts and things like that, so that there's an element of where he's actually kind of doing his own research and trading to some degree, as in addition to just sort of acting as a financial advisor. However, he emailed me with certain thoughts about my columns, and his basic thrust, and this was very, very close to the 2009 low, was, and he had sent me, by the way, there's something he wrote in 2007 before he was in touch with me, and I verified the date, when he more or less called the top in 07 of the market. So anyway, he sends me this lengthy kind of email with his thesis, and it basically says, and every time I pushed back on it, he said, because the financial crisis is over. And this is like April of 09. And like literally nobody thought the financial crisis was over. What they thought was, oh, maybe we've seen the worst, or maybe it's easy, and whatever the rationale. And I was just impressed with just how he was able to boil things down to what seemed to be discounted already, whether we passed an inflection point, all these both technical and fundamental inputs that he used. So in a column, and it was I used to write a short column, a few hundred, 600, 800 words, whatever it was. I just detailed this guy's view in pretty significant detail. And I introduced it in a way, I was like, so there's this guy who emails me, basically trying to characterize exactly how I came upon him. And people went nuts. I mean, the reception, I think part of it was a very kind of tightly wound moment in the markets. If you were saying the bottom was in April of 09, a few weeks after it was, you were really going out on a limb. And then later in that year, I said, he's basically says, this is not a bear market rally. This will be a multi-year thing. We're probably going to have pullback, et cetera. So he's very tactical along the way, but it just gained this following. And I never really intended to make him a regular feature of what I did, but people would ask all the time, and they would also criticize me for amplifying this guy's views without giving his name, and there was no real accountability and all the rest of it. And so it carried on from there. He just stayed in touch. I've literally never met him in person. I mean, I know who he is. I've checked out the background and all that. And he's never telling me anything that would be like insider-ish. It's just kind of his observations and his analysis of what's happening. And so what's fascinating is Twitter is like a little bit of an ideal way for this stuff to propagate. And I would put stuff out there, and I think even when I was at Yahoo, and I created the hashtag because people would constantly ask me what he said before. So it's sort of all in one place. And I just think first of all, he's not always been right, but he's been more right than not typically. He comes from a particular discipline. I think I would characterize him as being kind of in the Marty Zweig, very focused on some like monetary and fund flow and rate of change type stuff. But he'll certainly pick individual stocks and he'll do work on individual stocks as well. But it's just amazing to me where it's come to. Also, has been an influence on how I think about the markets to some degree. And I try to actually make sure that I'm not bending my view in a direction because I either want him to be proven right or wrong. I try to disassociate my current thoughts with like what he's like. For example, just recently, he basically saying like the rotation into value has got years to run. Here's why, and he's playing it. And I don't disagree with that, but I wouldn't be so bold as to actually assert that myself, right? But again, the lesson in how people view and treat what seems like kind of secret backroom information from an unnamed source is really an interesting lesson, because I truly believe if people kind of knew his name and what he did day to day, he would just be another guy and he would be another voice. And maybe he would be one that people respected a lot, like a David Tepper, where he doesn't say much all the time, but when he says something, people think that it carries weight. Or maybe he would just be like one of the many voices that we have on the air all the time, who, because of their familiarity, people don't put on a pedestal. It's really kind of an unintended phenomenon and kind of an interesting one.
So he's like your reoccurring deep throat, essentially.
Right, exactly. That's kind of how it's...
So years after his death, hopefully many years from now, you'll reveal him as, the way they did with Mark Felt.
Right. And wasn't that a good example of that though? Because I feel like when Mark Felt was shown to be deep throat, people were like, oh, okay. It wasn't like some bombshell, because he kind of knew what was going on, but it wasn't so scandalous that he was one of the top guys or whatever. So, but no, that's exactly right. And in fact, I've asked him if he, would be interested in a reveal, and he's just not. I just think temperamentally, he just doesn't really want the attention, but clearly he loves to be right. And he just interestingly seems to like having that limited amount of publicity.
I hope you've been enjoying the latest interview with Michael Santoli. To be sure to never miss another World According to Boyer episode, please follow us on Twitter @BoyerValue. Now back to the show. You were at Barron's, covering September 11th, and I know you and I have kind of talked about it a little bit off air. What did you take from your experience covering September 11th from a financial journalism perspective that you currently applying to COVID?
Sure. I think one of the first things is a recognition of how markets will turn before it feels like it makes any sense to turn. The overshoot reaction on the downside, and then before you really think the coast is clear, the markets will respond most likely, especially when there's some kind of an overwhelming policy response as there was then. Now, clearly, it was a bear market before September 11th. It kind of gave way to a further bear market months later. But, the week after September 11th, and when I was at Barron's and, we were in the World Financial Center across the street, and, I had no crazy drama about the day, but of course we were displaced and the industry was completely hollowed out. It was obviously all the reasons we know, pretty rough time. We put out the paper that week, and of course you remember the markets remained closed through that week. So it was much more about trying to speculate on economic impact and what's going to change and everything. So then the markets reopened the following week. I think the Dow opened up down 7, ends up being a pretty nasty little correction. And going into the next weekend, the editors thought, they wanted me to write a market piece and, make a call on what happens next. And I was completely nervous about it. I really didn't know if we could be confident of the terms even under which we were trying to make this estimation. And we ended up basically going with a cover story that said, time to buy stocks now. So that would have been, let's see, 17, like September, the issue of September 24th or something of '01. And that's about, we kind of got lucky timing wise on it. And market went up 20% from there over the next few months before it did roll over again. So that was a lesson to both of why you're always going to be nervous when you're deciding that the markets have already handicapped or discounted awful events, and also why you should never be surprised at how violently they react. The other thing that I think I'm carrying over here into COVID, and did from the beginning, is to be skeptical of that reflex strain of analysis that says, after this crisis, everything will change. After this crisis, our behavior will fundamentally be different. And now some of it, of course, will. But I just think back to 9/11, and nobody thought we were getting back on planes as fast as we did. Nobody thought that there would be international travel. And of course, we were worried about the war and what would it do to the economy and everything else. And so I just feel as if I'm just reserving judgment on a lot of those things. And right now it's all about, like, are people really going to stay away from the office? Are people never going to be comfortable on planes or again? And obviously it's unique in the sense that we sort of have defined, medical signposts for all this stuff and when it might get back to normal. But those two things, more than anything, I think inform how I'm trying to go about covering things this phase.
Yeah, I mean, I'm always skeptical when people say the world is going to change. We had David Rubenstein on the last podcast, and he kind of had similar views. To me, what's amazing was if you had just looked at the headlines, starting in, I guess, early March, and you had the chance to look at the headlines through today of what has occurred. I mean, and you saw that over the past 6 months, the S&P is up 27%, up 14% year to date. The NASDAQ has advanced about 32%. I mean, was there anyone emailing you or telling you that this is what is going to occur, that this is actually, like the mystery broker said in April of 2009, this is the time to buy stocks?
I don't think anybody said that it would happen that quickly. I think that it goes in these little increments. I think anytime that, the S&P was down almost 35% in 5 weeks, that's usually a close your eyes and buy just for a bounce type of thing. And so I think it goes in these phases of, okay, fine, you can play for the bounce. We're mega oversold, maybe the most ever. We've already kind of discounted a wipeout of earnings or something for earnings growth for this year and all the rest of it. But no, I don't think anybody really thought that it would round trip as quickly as it did. Now, what's been fascinating is the way it did it, of course. And so I do think that all you would have had to say is that, like, oh, well, the mega cap growth stocks are going to be considered to be bond proxies and sort of the safety trade, and they're going to expand their valuation up to 35 times forward. And that gets you a long way toward the S&P getting back to the old highs. But no, I think what's been interesting this time around is that you had such disagreement going in as to, like, how much of an economic event this was even going to be. I'll be perfectly candid that through February, I was in that camp that said, look, we've heard about these, we've had these pandemic scares before, they've been localized, we've gotten lucky. They've never, if you look back, you never felt like it was smart to sell on the Ebola scare or the SARS crisis or anything like that. So I was definitely not one from an early stage that was saying this is going to be big. So I didn't feel equipped to make the call on the other end of it very well. And not that I make calls even, but I do think that one of the main tasks I found myself, assigning myself here at CNBC, and it's gone on everywhere, is trying not to pretend that every step of the way and every day the market had it wrong. Because it was very easy to say, what the hell is wrong with the stock market? They don't get what's happening with 20% unemployment and shut down economies and mass business failure. You go down the list. And I think it comes down to what the stock market does and does not capitalize in a given moment. And what stock market we're discussing. As I said, the NASDAQ 100 is like perfectly positioned to be a net beneficiary of that type of environment, and it showed through. I mean, the other piece of it, though, is, and this might be the most enduring impact of this period in terms of economics and fiscal policy and things like that, is basically short-circuited a recession with massive proactive response, right? 3 trillion from Congress, another 3 or 4 trillion from the Fed incrementally, whatever it's been. And it completely washed over the economy and did buffer things in a way that you wonder down the road if it's going to just be considered to be like, well, why aren't we doing this? Like, are you going to essentially just like overwhelming force to try to prevent recessions because you haven't yet gotten any of the bad side effects of that necessarily so far? So it's been surprising to me, but I think once we got into the summer and the market felt as if it was just handicapping a process that it could monitor day to day, whether it be on vaccine development or whether it be on reopenings. And there's a sense that we kind of created all these new metrics. They've been plugged into the machines and the market was happy to just kind of discount them day to day with every incremental data point. At that point, it didn't become, all that surprising to me. Also, the earnings floor was, I think higher than most people thought it would be for a lot of companies. They just sort of like suspended guidance, raised a ton of debt, created vast liquidity, planned for the worst, and then maybe the worst didn't really last more than a couple of months.
Something near and dear to my heart, and you had mentioned that the mystery broker had said to you, had talked about to you, or you think we're really in the midst of a rotation from growth to value? And how do you think it's going to unfold? I mean, I've seen head fakes for the last 3 or 4 years, so I'm trying not to get too excited on any of these moves, but it does feel like there might be something there.
Yeah, I'm on board with the idea, and I think of it a little more as just kind of a more inclusive market, a broadening out, and on a relative basis, stuff that's more cyclical, tied to better nominal growth and just cheaper. It does seem as if there's certainly a window for that to work better. Where I've struggled is the idea that with the major indexes at all-time highs, that somehow in a wholesale way, people are going to retreat from like the best business models in the world with the highest profit margins and reallocate in a major way into laggards and value and cheap stuff. So in other words, my point is, I don't think it's a zero-sum game. It doesn't seem as if growth stocks have to fall apart. They probably get derated a little bit, and they'll just have to, have earnings growth that is not matched by stock price performance. But I find a little more satisfaction in talking about cyclical as opposed to value, because I think you get a little bit bound up in some of the weird statistical value measures that maybe don't tell you much. One of the issues is obviously in many sectors, if you're buying cheap, you're buying the disrupted. I just don't know to what degree that's fully been discounted. I think to a large degree it has been discounted, that disruption cycle, these companies have been living with it for a long time, or they're now such small parts of the index that doesn't really matter, and the rest of value will take over. I see the opening for it, but it's tough for me to think that it happens as a easy pass of the baton at all-time highs from one style to the other, as opposed to kind of in the mess of a correction or even a bear market. Although maybe the last several months collectively was that kind of hashing out process. I'm not really sure, because I mean, you obviously remember in 2000, indexes did terribly, growth fell apart, and value didn't have a bear market.
I love those days, and our view is kind of, this is not a 2000. Those leaders are actually really solid, good businesses. I just think the rest will kind of play catch up. But does an Apple deserve to trade at 30 some odd times earnings? Should it be trade more like a kind of a consumer staple? That type of thing might happen. Amazon's in its own orbit. How that plays out with regulation will be interesting to see. But it's that's what makes it really interesting. And one of the things I see you utilize, we don't use it just because it's just not part of our style, but I'm not saying that there's not a reason for it. And I think a lot of people do it very well, is technical analysis. Yeah. How do you think investors should be thinking about technicals when making kind of their buy and sell decision? What should they really be paying attention to?
It's interesting because, first of all, I am a complete sort of amateur practitioner, and I don't really consider myself a technician or either by belief or practice. But I do highlight a lot of technical metrics, and I do view the world to some degree through those frames. And the reason I do it, to be honest with you, is I'm always looking for context. I'm always looking to place what's happening today in terms of what came before. And I want to get a sense of trend. I want to know if this is just a continuation of what's been going on, or if it's been some kind of an aberration and whatever. So I don't really focus as much on levels and absolute price signals and targets as much as saying, like, you have to have a really good reason to fight an entrenched trend. If the price hasn't got diverged massively and decided to get very overbought or oversold, the trend is something you should probably, it's like path of least resistance. And I also do think that, like, I follow people who make very persuasive arguments that, like, if you see a stock that falls out of bed, that gets oversold, but it's in an uptrend, there's your opportunity. Those are the types of dips that you want to buy, and vice versa. If some oil and gas stock is in this disgusting looking downtrend and it just pops 20%, don't think that's a trend reversal. You need some more confirmation. So to me, it's about listening to the market as much as telling the market what it ought to be doing. But I'm not one of those people who says the only truth is price and fundamental analysis is useless. And for me, it's more of a convenience to how I should portray what's happening in the market graphically and narratively than it is believing that technicals are magic in terms of trading or investing. So, I make that distinction to some degree, but I'm a huge baseball fan, and it's like, I believe all the statistical kind of high-powered statistical stuff that people have come up with. It's an amazing way to decide, like, what matters in a game and what types of players might be more or less valuable. But it doesn't really entirely replace having a sense of who performs well in better situations and trying to project out how a team might perform or something like that. So I also like to see the game unfold. Let's be honest. I mean, what I'm mostly doing is kind of color commentary on the action, not predicting the next move, but just trying to kind of give some perspective on how it's been going. And I think the technicals at least help me do that.
Michael, you've been more than generous with your time. You've gone 15 minutes over than what I told you would be. And I know you probably have some stories you need to cover. So I want to thank you for appearing on The World According to Boyer. And I really appreciate your time and insights. And to be sure to never miss another World According to Boyer, please follow us on Twitter @BoyerValue. And Michael, again, thanks for being on the show.
It was great. It was great to talk to you.